Let me tell you something right off the bat, and I want you to hear this clearly, because what I'm about to say may very well be the most important truth you will ever encounter in all your years of trading. Most of the indicators you rely upon every single day are nothing more than lagging traps, beautifully designed, brilliantly marketed, and quietly, methodically built to bankrupt the retail investor. I do not say this from theory. I do not say this from rumor passed between men at a brokerage house. I say this because I have spent the better part of my life through the booms, the panics, the crashes, and the great bull runs of the early 20th century, watching these traps be laid with the precision of a surgeon, and watching ordinary men walk straight into them. My name is Richard Wyckoff, and today I am going to pull back the curtain entirely. You will understand, perhaps for the first time, exactly why these so-called tools are working against you. Who benefits when you follow them blindly? And, most critically, how you escape the trap before it closes around you. Stay with me. Every word of what follows matters. Now, before we go any further, I want you to perform a small act of honesty. Think back. Truly think back to the last time you entered a trade because an indicator told you to. A moving average crossover, perhaps. A flashing signal from your RSI or MACD. You felt it, didn't you? That electric certainty. That whisper in your mind saying, "This is it. This is the one." And then the market reversed. Your stop was hit, and the voice changed, didn't it? It became quieter, more doubtful. It said, "Why does this keep happening to me?" That, my friend, is not bad luck. That is the machine working exactly as it was designed to work, and until you understand the machine, you will keep feeding it. Let me show you precisely how it operates. Consider the moving average. The 50-day, the 200-day, pick your preference. The principle is the same. It calculates the average price over a stretch of past sessions and draws a smooth line upon your charts. Reasonable enough on its surface. But here is the fatal flaw. By the time that line curves upward and signals a trend, by the time it whispers to you, the move is happening. The men who set this market in motion have already acted. They accumulated their positions in the quiet. They built their cause in the shadows of a sideways range when no indicator on earth was singing anything interesting. And when the price finally broke free, and your moving average crossover lit up like a theater marquee, those very same men were already preparing to unload. You were not catching a trend. You were buying their exit. I watched this exact sequence destroy a young trader I shall call Thomas. Thomas was a disciplined man, earnest and studious. He followed his signals religiously. Every crossover, every oversold reading, every flashing confirmation on his charts. Week after week, I watched him enter trades with confidence and exit them with confusion and loss. He was not undisciplined. He was not foolish. He was simply trained to react late. And in this market, reacting late is the same as reacting wrong. Now here's a concept I want you to lock into your mind, because it explains everything. A moving average crossover is like reading a man's diary. To predict what he will do tomorrow, the diary tells you only what has already occurred. His thoughts have moved on. His intentions have shifted. And while you sit there reading yesterday's entry, he has already gone out and acted. This is the fundamental nature of lagging indicators. They measure momentum after it has manifested. They confirm trends after they are already underway, and by the time they speak. The professional operators who truly move markets have long since made their move and begun making their second. Now, I know what you may be thinking. Richard, surely there is some value in confirmation. Surely it is prudent to wait for the signal before committing capital. And to that I say, you are not wrong that confirmation has its place. But confirmation from a lagging instrument in the hands of a trader who does not first understand the underlying structure of the market is not prudence. It is a delay that costs you the entry and then hands you the loss. Let us speak for a moment about the nature of the professionals. The market is not a random machine. It is not an impartial mechanism that simply records supply and demand. It is a battlefield On one side, the great operators, the institutions, the houses, the men of capital who have access to order flow, who understand the structure beneath the price, and who possess the means to move markets in their favor. On the other side, the retail trader, armed with charts full of colorful lines, arriving to the battlefield with yesterday's intelligence. The professionals understand something the retail trader does not. They understand that when enough retail traders are watching the same indicator, that indicator becomes a weapon aimed at the very people following it. Here is how the trap is sprung. A stock has been rising steadily. Moving averages are curling upward. RSI is bullish. MACD shows positive divergence. The retail crowd, seeing these confirmations accumulate, feels emboldened. The inner voice grows confident. All my indicators agree. This is a safe entry. And so they pile in. At precisely the moment, the professionals are selling into that buying pressure. The price cracks. Stops are taken. Retail holds losses. And the operator has collected his profit. From the very enthusiasm the indicators help to manufacture. This is not conjecture. I observed this pattern in the great bull market of the 1920s. In the months leading to the crash of 1929, every conventional signal was bullish. Price rising, moving averages trending upward, volume increasing. It was, as I called it then, a sucker's paradise. The smart operators were distributing, quietly selling their accumulated shares into the hands of an eager indicator-following public. When the crash arrived, those same indicators flipped to sell. But by then, the damage was complete. Now, I want to pause here, because this is a turning point in our conversation. Up until this moment, I have been telling you what is wrong, what is broken, what is being used against you. Now I'm going to tell you what is right, what works, what the professional operators themselves use, not to signal entries, but to read the living intention of the market itself. The answer is this: price and volume. These two elements are the heartbeat of every market that has ever existed. Price tells you what the market is willing to pay at this precise moment. Volume tells you how much conviction stands behind that price. Together, when you know how to read them, they reveal the footprints of the operators. They tell you, in real time, whether the professionals are quietly accumulating or calmly distributing, and that intelligence is worth more than every indicator on your chart combined. Let me give you a concrete picture of what this looks like in practice. Imagine a stock that has been declining for several months. The public has lost interest. Indicators are uniformly bearish. The charts look, to most eyes, unremarkable, a flat, lifeless range of sideways movement. But watch the volume. On the days when price dips slightly, volume swells, and yet price barely moves lower. What does that tell us? It tells us that every attempt to push the price down is being absorbed. Someone is quietly buying every share the sellers offer. Someone with deep pockets and patience. That someone is the operator, and he is building a cause. I call this phase accumulation. And I want you to understand, no moving average will show you this. No RSI will flash a signal. Your MACD will still be whispering, bearish, bearish, stay away. But the charts, when you know how to read them, are telling an entirely different story. Here is a challenge I wish to set before you now, and I ask that you take it seriously, because it will rewire the way you see markets. Take a chart, any chart, a stock, a commodity, it matters not. Remove every indicator, every moving average, every oscillator, every colorful line that promises certainty. Leave only two things: the price bars and the volume. Now sit with that chart and ask yourself, for each significant price movement, did volume expand on this move or contract? Did the price close near its high or near its low? When price tested level twice, what did volume do the second time? Sit with those questions. Do not rush to answers. Let the chart speak to you, because the chart, when stripped of its decorations, does not lag. It speaks in the present tense. Every bar is a live report from the battlefield. Now let me share with you one of the most instructive moments of my own trading life. It was during the depths of the Depression-era markets. The public mood was one of absolute despair. Stocks had been falling for years. Sellers had beaten buyers into submission, or so it seemed. Every momentum indicator screamed downtrend. Every moving average confirmed the collapse. And yet, I was watching a particular stock on my charts with great attention. The price had been in a range for several weeks. Then, one afternoon, it broke sharply below the lows of that range on heavy volume. Panic sellers flooded in. Every indicator confirmed, sell, get out. The trend continues downward. But I looked more carefully. The price had broken below the range and then closed back above it. By the end of the session, it had recovered everything it lost, and the volume on that recovery was enormous. I recognized this for what it was, not a continuation of the downtrend, a spring, a calculated shakeout by the operators, designed to exhaust the final sellers, to take their stops, to create the impression of collapse, before launching the next advance. I entered that trade. The indicators did not agree with me for weeks, but the market did. By the time the moving averages finally curled upward and announced the new uptrend, the stock had already doubled from my entry. That is the difference, my friend. Not in intelligence, not in luck, in the language you choose to read. Now let us discuss, methodically, the 4 steps I employed then and employ always, because understanding a concept is one thing. Applying it under the pressure of a live market is another matter entirely. Step 1. Identify the market phase. Is this market an accumulation, where the operators are quietly building positions in a range? Is it in markup, where price is advancing and the public begins to notice? Is it in distribution, where the operators are offloading their holdings into public enthusiasm? Or is it in markdown, where price declines, often with panic, as the public realizes too late it has been left holding the bag? Until you know which phase you are in, no signal, lagging or otherwise, can save you. Step 2. Read the volume story. Where does volume expand? Where does it contract? Volume expanding on a down move that nevertheless holds support, that is, absorption. The operators are buying what the frightened public sells. Volume contracting on a rally, that is, weakness dressed as strength. No real conviction behind the move, a trap for the eager buyer. Step 3. Watch for the decisive price actions that reveal intent. The spring, a false break below support that reverses with authority. The upthrust, a false break above resistance that collapses just as quickly. These are the operator's signatures upon the charts. Learn to recognize them and you will never again mistake a shakeout for a breakdown. Step 4. Only then, only after you have identified the phase, read the volume and confirm the intent through price behavior, do you act. And at this point, if you wish to glance at an indicator for a secondary confirmation, you may. But understand its role. It is not the general. It is the messenger, the slow messenger who arrives after the battle has begun. Useful, perhaps, for context, never the basis of your decision. I want to speak now about psychology, because it is here that the lagging trap does its most insidious damage. You see, the indicator does not merely mislead you about the market, it misleads you about yourself. When you surrender your judgment to a blinking signal, you are training your mind to distrust its own observations. You stop asking, what is the chart telling me about the nature of this move? And you start asking only, has the line crossed yet? Has the color changed? You become, in effect, a machine, waiting for permission from another machine. And when the loss comes, and it will come, you have no foundation from which to learn, only a signal to blame. But when you trade from genuine understanding of price and volume, when you see the accumulation forming, recognize the spring, read the conviction in the volume, something remarkable happens to your psychology. You become calm, not because you have eliminated uncertainty, no honest trader will ever claim that, but because you understand the story. You are not a passenger waiting for signals. You are at last reading the market on its own terms. Let me now address the most common lagging tools directly, so you know precisely what you are dealing with when you see them upon your charts. The moving average. Smooth, reassuring, and perpetually behind the price. In a strong trend, it will keep you positioned correctly, but you will have entered late and exited late. In a trading range, it will whipsaw you mercilessly, generating signal after false signal as price oscillates through the average. Remember, the market spends more time in consolidation than in trend. The moving average shines in the minority of market conditions. It struggles in the majority. The relative strength index, it measures momentum, the rate at which price has moved. A useful piece of context, nothing more. In a powerful trend, the RSI can remain in overbought territory for months while the stock continues to advance. The trader who sold because the RSI crossed 80 is holding a loss and watching a runaway market from the outside. The inner voice mutters, "It has to come down. It simply has to." The market does not care what it has to do. The MEC, a calculation built upon two moving averages crossed against a third. Layer upon layer of lag. In volatile, choppy conditions, precisely the conditions that professional operators create to shake out retail traders, the MACD will generate false signals with such frequency that a trader following it faithfully will be caught wrong more often than right. I am not telling you to throw these instruments into the fire. I am telling you to just enact them. They are not oracles. They are footnotes. Price and volume are the text. Now I wish to give you something practical to carry away from this teaching, an exercise, and I ask that you perform it with genuine discipline over the coming week. Each day you observe the market. Keep a simple record. For each significant price movement you witness, write down three things. First, what did volume do during this move? Did it expand or contract? Second, where did price close in relation to the range of that bar? Near the high, near the low, or in the middle? Third, what signal did your favorite indicator give? And did that signal come before the move, during it, or after it? Do this for 1 week. At the end of that week, review your records. You will see, with your own eyes, written in your own hand, the consistent delay between reality and signal. And that realization, personal, concrete, undeniable, will do more for your trading education than any course or system I could prescribe. In the modern markets I observe today, the same patterns persist. A great technology stock soars on enthusiasm. Retail traders pour in, encouraged by rising moving averages and bullish momentum readings. But if one looks carefully at the charts, at the volume behind each rally, one notices that the rallies are becoming thinner. Volume drying up as price pushes higher. The stock locked in a trading range for weeks while the indicators continue to flash. Strong, buy, hold, and then the break, sharp and sudden as the operators exit. The indicators confirm the fall only after it has begun. Retail is left trapped, wondering how a stock that looked so strong could collapse so swiftly. It did not collapse swiftly. It was being distributed slowly, over weeks. The chart showed it clearly to those who knew how to look. Let me leave you with a final image that captures the essential truth of everything we have discussed today. Imagine a detective arriving at the scene of a crime. He has two choices. He can rely entirely upon the newspaper report printed the following morning, which tells him what happened after the fact filtered through someone else's interpretation, or he can examine the scene himself. The footprints in the dust, the position of the furniture, the direction of the shadows, the evidence of what actually occurred in real time, unfiltered. The lagging indicator is the newspaper report. Price and volume are the crime scene. One tells you the story after it has been written. The other shows you the story as it unfolds. If you have trained your eye to read it, train your eye. Strip the charts, watch the price, read the volume, learn the phases, recognize the footprints of the operators in the springs, in the upthrusts, in the quiet accumulation beneath a lifeless range. And when you see those footprints clearly, act with patience and precision, not because a colored line told you to, but because you understand what is actually happening. That is the Wyckoff way. It is not a formula. It is not a system of mechanical rules. It is a discipline of observation developed over years forged in the pressure of real markets and paid for many times over in hard experience. And it is available to any trader willing to put in the genuine work. So here is your charge as we part ways today. Be skeptical of every signal that speaks to you from the past. Be patient with the market's present. Develop the habit of asking, not what does the indicator say, but what is the chart actually showing me right now about the balance of supply and demand, and do your exercise. 1 week, record price, volume, and indicator signals side by side. Let the evidence instruct you, because the market will reward those who anticipate, and it will punish endlessly and without mercy those who only react. You have the opportunity to be the former. Do not squander it, chasing lagging lights upon a screen. I am Richard Wyckoff. Trade with knowledge, trade with patience, and above all, trade with your eyes open. Until next time, stay sharp.